Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Lucid reported results recently, and it's hard to say that there's a lot to like about what we heard from the company. Deliveries is still extremely low. Cash flow is negative. The amount of cash that it's burning is unsustainable. And the stock is down 64% over the past year. So is there any light at the end of the tunnel for Lucid? That's what I want to get into. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I want to go to the earnings presentation because I think this gives a good idea of some of the keys for Lucid and where the company is sitting. You can see that deliveries were 1,404. Production was just 2,173. As a result, you had a revenue of a little over $150 million. Total liquidity is $6.25 billion. Keep that number in mind because this is something the management talks about a lot because liquidity is becoming more and more important for the company. What I'm most interested in is the company's operations and capital expenditures. That's these final two segments here. And I want you to look at revenue, cost of revenue. So this would be the gross margin line, R&D expenses, and then SG&A. You can see that revenue of $150 million isn't anywhere close to covering cost of revenue. So they're going to have to increase production by 5, 6, 7x just to maybe break even on each vehicle sold. That's even before covering R&D and SG&A expenses. So the net loss, $764 million just for a single quarter. Cash flow is even worse because then you add in capital expenditures, negative $904 million just for the quarter. And remember, there's about $6 billion in available liquidity. So given that, Lucid has about 6 quarters worth of cash, not a lot of cash. At the same time, this is what I think is the most troubling for investors, is that the price point of these vehicles are extremely high. We have seen the trend for almost every other major EV manufacturer be to lower prices, whether that's in the US or it's Chinese manufacturers specifically selling in China. There's been a price war there. To get into a Lucid, you're talking about $80,000 that doesn't qualify for tax credits in the US. And it just seems to be pricing people out of the market. Right now, I think investors really need to think about what Lucid's future is going to be, because right now there isn't enough cash to get through the next couple of years at the current rate. Production is not ramping all that quickly. And I'm not sure we have demand for a lot of $100,000, $125,000 electric vehicles when you can now get an electric vehicle for under $30,000 in a lot of cases. I think this is just a really tough market to be in. And the best alternative is maybe to be acquired by one of its major investors, like the Saudi Arabia Investment Fund, which put a lot of money into the company over the past year. But from an operational perspective, Lucid just is nowhere near any of its major competitors like Tesla. And without major backlog and demand and increasing deliveries, I just don't see how this company has a viable financial future where it stands today. More dilution may be coming by selling more stock. A sale may be coming to somebody else. But as a standalone company, I just don't see a great future for Lucid. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.